This episode, we have something special for you. I recently had the opportunity to moderate a live panel discussion between Jean-François Perrault, Chief Economist at Scotiabank and a regular on our show, and Myles Zyblock, Chief Investment Strategist at Scotia Global Asset Management. The theme of the panel was an economic look ahead, what might be in the cards for the next few months and into 2025 based on their latest Outlook report. So this episode, we're bringing you that whole conversation. It was recorded on October 29th as part of the recent Scotiabank Global Wealth Management Thought Leadership Summit. Our chat touched on everything from what the results of the US election might have on stock markets and investors, Canadian and global economic outlook, how AI is reshaping companies and workforces, and much more. I'm Stephen Maurice, and this is Perspectives. Now, here's Jean-François Perrault and Myles Zyblock, live in conversation at the Scotiabank Centre here in Toronto. Myles, JF, thanks for being here today. If you were to take a snapshot of sort of the landscape right now, you'd see modest economic growth, you'd see stock markets doing pretty well, you'd see interest rates coming down more or less quickly, you'd see inflation possibly beaten, unemployment going up a bit, but not crazy, families apparently being able to deal with the spikes in interest rate and managing their mortgages, all that. Looks like a not bad situation. JF, could you maybe just give us briefly, we'll get into all the factors that will affect those things going forward, including one big elephant in the room, but could you just briefly talk about how you see the macroeconomic landscape right now? Would you say that we have stuck the soft landing, as Bank of Canada has suggested?
Well, I wouldn't say that we have, but perhaps they have. It is, in many ways, quite remarkable. We had a historic increase in inflation, obviously very significant rate increases coming out of that in Canada and elsewhere to slow growth, ultimately slow inflation, which seems by and large to have worked without triggering a significant reduction in economic activity and a significant pickup in unemployment. There's been a pickup in unemployment here and there, but has been pretty modest overall. And that constellation of elements hasn't happened before, right? So, people have this soft landing in mind. We've been talking about it for 30 years in my job. It's never happened before. And, it kind of looks like we are in that spot now. And, the more data that come in, the more that seems like that's the right way to characterize things. Actually, there's a question in the US as to whether they're even landing, never mind soft landing. If, in fact, we are where we think we are, it's a pretty remarkable thing.
And how do we get here? Is that just a question of how the bank
that's a different story. That's a different story. So part of what's extraordinary about what happened, so if we just look at Canada, for instance, that's an outlier in one dimension. We've had, basically since central banks started raising interest rates, and this is true in Canada, it's true in the US, it's true in some other countries, and more so in North America, you've had politicians not happy with what those rate increases have meant for people. And you've had politicians not happy with the decline in affordability that's come with higher inflation. So you've had effectively, in Canada very specifically, policymakers provide a lot of fiscal support as the Bank of Canada was raising interest rates to try and soften the blow. That's not what happens historically. That's meant that Bank of Canada's had to raise rates more, but the economy was better supported in that period of time. In the US, had a similar thing, except it wasn't from an affordability perspective, it was from a green transition perspective. So you had this very significant investment subsidy program called the Inflation Reduction Act, which is basically designed to subsidize machinery equipment spending in the US, in principle with the purpose of helping facilitate the green transition, which led to trillions, well, maybe not trillions, close to $1 trillion in spending to support the US economy at a time, again, when the Fed was raising rates to try to slow things down. So you've had this confluence of fiscal policy running across purposes of monetary policy, which really softened the blow and created a lot of economic spillovers. In Canada, we had the additional element, which is possibly reversing very rapidly, of extremely strong population growth, right? Record strength in population growth. So again, Bank of Canada has been raising interest rates to try and slow things down, see less consumption, basically. And you're adding millions of consumers over the 2 or 3 year period of time. So necessarily, again, that's completely ahistorical, but you've had this softening blow. So it's not necessarily the central banks have been particularly awesome at managing the cycle. It's that relative to previous exercise, previous times where they were doing stuff in isolation pretty well and others were kind of messing around in their backyard. You've had a couple of really big things just soften the blow of monetary policy to a very significant extent. So we've had stronger growth than expected the last couple of years as a result of that. And so far, a pretty mild downturn.
Huh. So is that a recipe for dealing with these sorts of situations in the future of massive government?
If you like not being able to afford a house, sure.
Yeah.
No, it's not. It's not. I mean, the reality is, so we did some work in Canada, for instance. So as much as fiscal policy might have helped people manage the inflation shock, manage the rate shock, if you back out, what would have happened had governments not given checks to a whole bunch of people, for instance, in Canada? You're talking about a rate environment where maybe the order of Bank of Canada have only risen rates to 3.5, right? So significantly less than 5%. So there's a cost to that, which is we all paid higher interest rates, but on balance, it's led to where we have.
Okay, Myles, how about you? I mean, I mentioned stock markets doing pretty well from a non-professional's point of view. TSX up something like 17-18% since the beginning of the year. S&P 500 more than that, 23, something like that. Is that the reality of the situation? Is it as rosy as it looks when you just look at those basic numbers?
It's a good point. So you look at the S&P 500, for example, the first 3 quarters of the year is up 20 some odd percent, and that's pretty much as good as it gets looking back historically. But one of the things that the indexes do mask is the action underneath. And as we know, and we've probably all been reading about, there's a few really big stocks, mega caps, the Big 10, let's call them. Some people call it Mag 7, Magnificent 7, or whatever, that have, for most of this year, until more recently, but for most of this year, they were really driving the bus. So when you have a cap-weighted index, and 35% of that cap-weighted index is these 10 stocks, and these 10 stocks are going vertical, like NVIDIA, for example, it doesn't really give you a sense of the breadth underneath. And you look elsewhere, Germany's not doing all that great, like different stock markets. So, I'm not saying they did okay. I'm saying the other 490 have done okay, but not really as good as you'd think, given if you just stared at the index. And coming with this big performance is increasing concentration risk in these markets. And in fact, these top 10 stocks now, 35% of market cap, that's basically a record over 100 years. So this is the most concentrated US equity market we've seen definitely in my lifetime, and in maybe a couple lifetimes for people. And now coming back to the point, and I think part of the idea here is that, we talk about these aggregate GDP numbers, and global GDP growth is, let's kind of track it around 3%. Long-term average is like 3.4% for global GDP growth, so we're a little below average. And you go, wow, but that's not that bad. But if you start dissecting that aggregate GDP growth rate, as you mentioned, Canada has been sort of working, if it's a 4-piston engine, kind of working on 3 pistons, maybe 2. Germany, same thing. UK, same thing. So they're not going into deep recessions, but they're sputtering. And the US is really the exception. Absolutely the exception, in my opinion. I mean, of the major economies. We can find like India or something that behaves a little differently. And so this kind of uneven growth or kind of lackluster growth is being reflected in corporate earnings trajectories. So the US's corporate earnings trajectory, particularly for the big companies, has been incredibly strong. And we know part of that is linked to AI, right? And all the sort of the CapEx that's going towards that theme, and it's juicing earnings. But if you look at the rest, look at Russell Small Cap Index, the earnings are going to be down 20% this year. Yet we're saying it's really kind of focused is what's going on. And you're seeing that with the behavior of equity markets until a little bit more recently, let's be honest, where the rally looks like it's starting to broaden out a bit.
Okay. We'll get into some of those details of that in a moment. I just wanted to start looking forward. And so you were both involved in the creation of the Outlook report. I was curious about the extent to which the outcome of that little event taking place in the US next week, you might have heard about, the extent to which the potential outcome of that instructed your outlook. Because I'm curious whether people oversimplify the extent to which one politician or another is going to have an impact on the global economy. Is that exaggerated, or can we in fact expect a significant difference depending on the outcome of next week's election?
I can start with that. So I think you got to take a bit of a step back and understand kind of the thesis behind the global recovery which you've got in mind, which is largely inflation is getting under control, central banks are cutting rates around the world, that's stimulating demand over the next 18, 24 months, so a pickup in global economic activity in the US, well, not an acceleration in the US, but a stabilization in the US, but pickup here, Europe, elsewhere around the world. There are varying degrees of pickup in those countries, but that's generally the idea, right? So we make the assumption in our most recent view, which is going to change in a couple of weeks, because we'll have to reflect that it's basically status quo going forward. Now we know it's not going to be status quo going forward, but the problem is you've got like one outcome over here, one outcome over there. And of course, the US election is 50-50 at present. What's damaging or worrisome about the Trump outcome is not so much, his policies with respect to tax cuts, which should probably be good for corporate America. He wants to deregulate. There are the things that are there that are pretty positive from a kind of growth earnings perspective, which are things he doesn't talk a whole lot about. He talks much more about tariffs, so a tax on imports, which is raising the cost of doing business in the US, probably retaliatory tariffs elsewhere. So if you believe he wins and you believe he does those tariffs, you got to think about things a little bit differently. And that's definitely inflationary. Now, is it inflationary to the point where it reverses the progress on inflation? It remains to be seen. Of course, he's got to do those. Does it reverse the progress on interest rates, or does it just mean the Fed cuts less going forward? So there's a big uncertainty then about, if he comes into power and he does the tariff stuff, does that narrative still hold that rates keep coming down, the economy accelerates coming out of that? And that is literally kind of one world or another, right? Now, the challenge with President Trump is he may very well win and not do many of the things that he's got in mind. So the next step for us would be in 10 days from now, the US election, hopefully have some clarity on the outcome. There'll be clarity from Trump's perspective, no doubt, but real clarity. The challenge then becomes, okay, so President Trump is the winner. What do we put in our forecast in terms of things that he is going to do? The tax cut stuff, that's obvious. So you get a short-term kick of growth for sure from that, almost for sure from that. But the rest of the scary stuff, you wonder, okay, there's going to be some rational thinking there. Is he going to do tariffs? Is he just going to scare people? How's he going to manage that? So it becomes a much trickier world. Harris, on the other hand, wants to raise taxes, corporate taxes, wants to do some stuff on the capital gains side, which scares a lot of very wealthy people in the US. And she's got other elements of the platform which are more social and housing related in nature. But for her to do that, she needs to control Congress. She's almost certainly not going to get that. So from our perspective, you kind of assume status quo if she wins to some extent. Trump is just a bit of a different case, assuming how aggressively he wants to pursue the stuff he's been talking about.
Right. I'll put the same question to you, Myles. I'm curious, it also connects a little bit back to what you were talking about before, just in that markets seem to have been more or less immune to sort of geopolitical events, just really big ones over the course of the last couple of years.
Yeah.
So is this just another one of those where markets carry on doing what they're doing and just wait to see what the impacts of specific policies are?
I've been doing this for 30 years, and every election is the biggest election we've ever seen. This could be. I'm just saying that is the narrative that goes on before every election. The last one, I remember when the world was coming to an end because of the election, was 2016. And they said, every headline from The Economist all the way to CNN to everyone said, if Trump wins, the market's going to crash. Okay, this was going on for weeks before that election. And then what happened? Trump won and the market went up. So would I have predicted that or not? I don't know. I'm just going to give you sort of a rule of thumb here. Over the past 100 years, when S&P earnings growth has been positive, the market's up 70% of the time. The earnings are up, the market's up 70%. It's not perfect. Sometimes the market goes down when earnings are up. That can happen, PE compression, that kind of thing. But here's the other thing. If earnings are down, the markets are up 33% of the time. In other words, if you have a very negative outlook on earnings, the odds are going against you to be very aggressive in the stock market. So I think the point being, and maybe we mentioned, is that I'm not sure November 5th is going to change completely. It might, bump it up a little more, growth, or it might bump it down a little bit. It's very dramatic, this stuff. But I'm not sure if any of what we're going to see is going to derail the economy completely, hence derail earnings. Now, just as a sidebar, I get, whether you're Democratic or Republican, you're going to spend a lot of money going forward. The Republicans' estimates are they're going to spend $7.5 trillion more over the next 10 years. Democrats, $3.5 trillion. That's still a lot of money, right? So these big deficits, big spending, big everything that maybe is partially why the US didn't buckle because of those high rates, partially, that just continues. I'm not saying it's right or wrong, but that's the way these platforms are being run right now. So, come back to simplify. When things are very complex and things are very noisy, I try to ask myself, is it likely that earnings are going to continue to grow or not? And if the answer is they're going to continue to grow, invest accordingly.
Okay. So, but given the uncertainties that you both talked about...
Volatility for sure. I'm not going to deny that there could be volatility. Again, going back that same 100 years, volatility in the equity market, realized volatility, tends to rise into the election. And that could happen a day before, 2 days before, could start tomorrow, I don't know. But that's typically what happens. And then once the election happens, volatility starts to come back down as people know what they're dealing with.
Yeah, to give you a sense of that, Steve. So In 2016, the economy did okay. To Myles' point, it wasn't the end of the world, far from it. Markets did fine. But there was a very significant increase in uncertainty, in particular trade policy uncertainty. Right? So threats about walking out of NAFTA, tariffs, all this kind of stuff. And that comes at a cost. So you can estimate that cost. And we estimated that cost. So we figure in the first term that US growth, on average, like cumulative, was about 2 percentage points lower than otherwise would have been because of this uncertainty. So you still had strong, like decent showing, but it could have been a lot stronger. If Trump wins, you just count on more uncertainty for sure. So maybe things at the margin are a little bit less good than they otherwise would be. Maybe they're worse if he acts on it as opposed to just saying that he's going to scare people. But you are definitely in a world where there'd just be more instability, right? I mean, and that's this is kind of psychological. We know with him, like he likes to destabilize. There's no question about it. That's part of his appeal. So that's kind of the base for us. He wins. We for sure put that in our forecast. Now, how much uncertainty rises, of course, is a secondary consideration. But you put in more uncertainty, and then, is that offset by tax cuts or various types of things, or is it amplified by tariffs or deportations or?
And we probably agree the makeup of Congress matters too. Right?
Oh, hugely so.
Yeah. So it's not just who's nominated as president, right? If you have split Congress, then a lot of this stuff gets watered down. But if, say, you have a red sweep, then that's the full story that he's talking about. So those are things to think about, and there's just a lot of uncertainty, as was mentioned.
Do you want to just stop for a minute on the tariff question and what the potential impact of that is in Canada? And should we be even anticipating what does the next round when USMCA gets revisited in 2026? I mean, it's all speculation, I guess.
Like you can do these really scary scenarios, and they're easy to do. But so Trump's tariff proposals are put tariffs on everything going into the U.S. The 10 or 20% depends, in China 60% or more. Like he's not going to do that, right? So that'd be like tariffs on oil, on raw materials, like on food. Like you got to think if he's of a mind to put tariffs on things, that's certain he's going to exclude. I think for us, the relevant point is just kind of directionally. You put tariffs on, inflation is for sure higher. Is it a lot higher, a little bit higher? Depends what he does. Is the impact on rates very significant or not? Again, depends on how aggressive he wants to pursue those things, but ultimately it's trying to figure out what's in his mind and how he's being advised. And we figure he's rational enough to not go the entire way and potentially tank the US. I mean, it's unlikely, but...
The one thing with these tariffs, it's right, I agree with that 100%. And the one thing with these tariffs, though, when Trump initiated them and then Biden added a few of his own administration, so we kind of piled on China. The one thing you've noticed over this time period is that China's export share has gone down. So it's hurt China's export market. But the net gainers have been places like Mexico, Taiwan, and others, many others actually. So there could be a redistributional impact here that we have to sort out as time goes on to see. First of all, we have to see what these might be, not just scary numbers, because I agree with you. I don't think he's going through 60% on everything. And so these are things you have to think about when you're thinking about the outlook, the redistribution, which could be positive, I think always investment-wise, which could be positive for some markets.
Okay, given all that uncertainty, you guys are in the forecasting business. Broadly speaking, global economic growth over the coming years, and then maybe you, JF, in the broader sense, and Myles, maybe I'll get down to some regional specifics.
Yeah, I mean, as I said, we're in the early phase of a monetary combination cycle, right, which is designed to raise growth. This question is whether that will be successful or not, but that certainly is the view that we have, and I think most folks have as well. So you're by definition almost talking about a recovery which will see global output growth more than historical average. Like that's the intent. You want to raise growth above what we call potential, central bankers call potential. Now, the big question there is not, set aside the US election, is probably related to China, which is the second largest economy in the world. It's been having a really hard time. Government's been trying to do some things to stimulate. They're probably going to roll out some more things to stimulate. If China doesn't turn around, then you're not going to get kind of 3.5+ growth in the world. That's just not going to happen. Mm-hmm. So there's a bit of a kind of an uncertainty on that front. Now, where we're encouraged is it seems like the Chinese finally understand the scope of the challenge they're dealing with, and they are rolling out pretty significant measures, and I think we'll continue to roll out measures until something actually bites. So we kind of are of the view that as we go forward next couple of years, 3-4 years, that we will find ourselves in a situation where growth is significantly higher than where it's been the last couple of years. And more importantly, will be much better balanced than what we've seen in the last couple of years. Because to Myles' point, he's right. Canada growth has been kind of crappy. European growth is even worse. China's been struggling for a while. Other countries have been struggling for a while. It's really kind of been the US driving everything for the last couple of years at least. You get into a much healthier world where more economies start to participate, and you get a kind of a broader sharing of growth and responsibility.
So having a hard time from a Chinese perspective means only having growth of like 5% a year.
Oh yeah, everybody else forget those numbers.
4.5, but whatever they are.
What does rebounding from a Chinese perspective look like? Like, what does it have to get back to?
Well, so, I mean, the Chinese have got these targets, right? 4.5%, 5%, depending where you're looking at. They don't mean anything in real terms because the numbers aren't all that real. But you just see it in trade flows. You'd see it in, the price of commodities. You see a broad range of things which suggests that the Chinese economy is actually back to growing at a healthy clip. Now, officially, fine, 4.5%, 5% would be strong growth for China now, but
it's not.
That
That's
just
not
doesn't
the
mean
right
anything.
And Myles, from an investor perspective, what does the success or failure of the Chinese economy mean?
From an equity lens, it doesn't mean as much, but I think, sitting here in Canada, I know that, for example, the value of our currency is not doing very well. Commodity prices have not helped the currency. And China is still, it's definitely the largest consumer of most industrial commodities out there, including energy. And energy, what is it, down $4 today? So it's not great for the Canadian dollar today. But I think one of the implications, if China could, stabilize and perhaps even reaccelerate a bit, is that you get those spillover effects into Canada, those positive spillover effects, whether it's through the oil prices, the commodity prices, the Canadian dollar, the terms of trade improving in Canada, the income effects of that, which would be positive, and maybe that would be a little bit helpful. So I think that's one of the big issues when it comes to China. If you want to talk about their equity market, that's a roll of the dice to me. And I mean, it is cheap. The equity market's cheap, really cheap. But I worry that it's cheap for a reason, because most investors, international investors, do view China and the way that the market operates with a skeptical lens. There is risks to invest in companies in China, and I think you really have to be an expert to dabble in the Chinese stock market.
Okay. One place that's not cheap, you talked about from an equities perspective, China is, the United States is not, and you mentioned that a little bit. Do you want to talk about that, how you're seeing going forward, to what extent this is being driven by that relatively small number of companies?
It is, yeah. I mean, a big chunk of it. So let's be clear, when you say the U.S. is expensive, you're really talking about the S&P 500 and the cap-weighted PE multiple. And then you sort of get underneath the hood and you say, well, those 10 stocks have a PE of about 30 now, whereas the other 490 have a PE of about 17. So I'm not saying 17 is cheap, but it sure isn't 30. So when you put those two together, the market looks quite expensive. Now, there are some reasons that, even the 490, the 490 that aren't the big guys, why they're a little bit more expensive than most markets in the world. And it's because if you actually look at the underlying growth profile of the US, these companies are very profitable. I mean, when you look at, US profitability, it's about 30% above non-US profitability, which means that a very small incremental positive change in revenue means a bigger earnings share for US companies. Right? So it's a growth market. It's a high quality growth market, even beyond those top 10. And so that's why there's a little bit of a valuation premium afforded to this market. So is it expensive? Again, yeah, it kind of is expensive. But what we've found through our work and through sort of our research is that if earnings continue to grow, which I think they will, that valuation risk is not realized. So, I'd say that the US is your growth market, if you want to oversimplify. Europe is a value market, but it's kind of maybe cheap for a reason. But you can find, if you're a value investor, you're thinking about a little bit more about opportunities in Europe. So the European stock market today is trading at a PE below the value universe in America. The whole European stock market is trading cheaper than the value universe in America. So it's a pretty cheap market. You have to be even more pessimistic about Europe than you are today to say there's probably not some opportunities there. I think there are. And just coming back to all this with the uncertainty, everything, you really, again, going back to my experience, you really want to make sure you're diversified within your equity sleeve to ensure that, we've seen it a little bit more recently where the small caps wanted to take off and people have forgotten about small caps, right? And they've been acting a little better. And if they get going, you never know. And I wish I had a crystal ball, but I don't. What we do have is a very focused process on portfolio construction. One of them is to make sure you're amply diversified.
And where do you situate Canada in that whole assessment? And then I'll follow up asking JF how we make that situation better.
So, Canada's been behaving a little better. It was behaving a little better more recently and actually lit up a little bit when interest rates came down and the interest sensitive benefited, and which is a big chunk of the TSX. You never forget, just to back up, a lot of times a call on the index is not the same thing as a call on the economy. Because, for example, if you look at the market cap weighting of the TSX, it looks nothing like the structure of the economy. So they could be very different things, right? Gold is massive in the TSX, as an example. So what I'm saying is Canada's, I view it similar to some other international markets. If you look at it from a sort of a country lens, it is a little bit of a special sit. It's barbelled between energy and financials kind of thing. Mm-hmm. And usually one does pretty well when interest rates are rising. That's energy, because it worries about inflation, pushing up inflation expectations, and energy goes along with that. But, then you have the financials on the other side. So to me, and how we build a lot of our portfolios is from the bottom up. I would take that sort of approach when you're thinking about Canada, more so than just being naive and say that, Canada's either a good or bad investment because the economy is either good or bad.
Right.
It doesn't entirely hold up.
Okay. Jeff, I wanted to ask you about a specific and recent thing that potentially has a whole bunch of ramifications. That's the federal government's announcement last week about immigration and like a pretty severe pullback on what they've been doing over the last few years. Looks like they're predicting themselves an actual decline in the Canadian population in 25 and 26. Leaving the politics of it aside, what are the implications of that from a job market perspective, from a housing perspective?
Yeah, we don't know. And we don't know because, so the announcement was a change in immigration policy last week. As you may know, Canada's been growing by roughly 1 million people a year for the last 3 years, more than that this year. So rate of population growth in the 3 to 3.5% range, 3.6 to be precise, the most recent data here. That's created all kinds of opportunities and challenges within the economy on the affordability side in particular, and provision of public services. It's a political issue, so the government decided to crack down in a very hard way. So the announcement was that they would seek to engineer a decline of population next year, and another one the year after that, through effectively the removal of about 900,000 non-permanent residents over the next couple of years. 450,000 next year and 450 the year after that. Now, there'd be some permanent immigration as part of that, but on balance, the permanent and the non-permanent give you a slight decline of population, which is a very significant change from obviously the last 3 years. The extent to which that will be disruptive depends on how they go about doing it. To us, it seems completely unrealistic, right? You're pulling 900,000 workers, most of these folks are going to be working, out of businesses at a time when the labor market is still reasonably tight in Canada. Wages are still growing 4 or 5% a year, so there is some tension there. So we expect that either they're going to be very slow in rolling this out, or the guidance with respect to the types of individuals that they seek to exit from the country will be concentrated in parts of the economy which are not overly impacted. Could be some students, could be non-permanent residents who don't have jobs. We're not sure. But on the face of it, for sure, like you go from a world where your population is growing very strongly, helping growth, creating challenges, depressing GDP per capita, driven consumption per capita, to a world where you don't get that oomph. In fact, you get a little bit of a pullback. So almost certainly we're going to revise our growth outlook down for Canada next year, maybe the year after that. The impact on interest rates really depends on how what we call the supply-demand balance changes. Are you, removing people from the economy that are consuming just as much as the people that remain? Probably not. How is the productive capacity economy adapting to that? That all really depends on the details of this thing. So at present, in fact, the governor talked about this last week. He was asked about it as well, and he said, listen, looks like it's probably going to be neutral for the economy, lower for growth, but doesn't change the supply-demand balance, and therefore doesn't change our assessment of what we need to do with interest rates. But we'll only know once we get additional details as to how they plan to roll this out. On the face of it, it's just such an overcorrection that you figure, there's no way this is going to stand because it's just so aggressive, right?
And potentially they're losing skilled labor or not bringing as many in as they used to be.
Well, that's it. Will they target students? Or they've already announced students, but will they target students more? Will they target folks that work in, say, minimum wage jobs? Will they target folks that are in some other part of the economy, in remote communities, cities? We just don't know. I mean, it's a big change, but we just don't know how it's going to work.
Yeah. Myles, any good thoughts on that?
I mean, the only thought I have has been talked about quite a bit, that with the population boom we've had over the last 3 years, GDP hasn't been very good. Shockingly, because our productivity stinks, basically. And, hopefully AI helps that for the future, but we'll see. But now you just take a bunch of people out of the system, how's it going to look? Assuming they're actually going to do what they say. I don't know. But it's just something to keep in mind, especially when you're thinking, maybe bond yields do go lower.
One way in which this probably will have an impact is if you think of pulling 900,000 people out of the labor market, or a fraction, say half a million, we don't know. The reality is that these people were brought into the country to work in jobs that were difficult to fill for businesses that are already here. So if you got to replace 500,000 workers, 900,000 workers, that is almost certainly bound to put upward pressure on wages, right? So in principle, it could be inflationary. That being said, there is a productivity offset to that. If all of a sudden firms find it harder to find workers, maybe invest more, maybe they raise productivity, which actually would be a really good thing. So that wage increase might not be inflationary if firms are able to manage that in kind of a technological sense. But it seems at a very minimum that from a planning perspective, firms should be thinking about a little bit more wage inflation next year than otherwise would have been the case, and the year after that.
And impact on housing more generally, touched on it briefly.
Well, yeah, so the Minister Miller, when he announced this, basically indicated one of the justifications is just take pressure off the Canadian housing market. And on his estimation, you need 607,000 less homes as a result of these moves. In a world where you need 4 or 5 million, so fine, sure, 600 grand is a decent amount. But you're still many millions units you're short. So it's not a game changer in that sense. What could be an impact though is if this leads to lower employment in the construction sector, so you lose some skilled trades, or even more importantly, it acts as a deterrent for foreigners to come here with skilled trades because they figure there's a risk then that this instability, the immigration system might see us depart. But the housing market is, in Canada, as I'm sure you all well know, it's characterized by this extremely large gap between the number of homes we need versus the number of homes that we've got. In a very fundamental sense, right? Households versus dwellings. It's not, I want to have 6 homes. It's not that. 1 home for me, 1 home for everybody else in the room. And that gap, the federal government estimates is in the 4 to 5 million range. So it's extremely large. So as we think about it over a period of time, obviously rates matter a lot for housing. Housing has been pretty stable so far this year. It's picking up again, thankfully. But our concern as we go forward is that as the rates come down, as people kind of re-engage in the market, as they remind themselves that there is this huge gap between supply and demand, that if anything, house prices over the next 5 or 10 years, it'll be a sustainable path, but on a path that really makes affordability a challenge for more and more Canadians. So good thing if you're a homeowner, not a good thing if you're a prospective homeowner, if you got kids who want to own a home. And likewise, probably similar dynamic on the rent side over a period of time. Now, in the short run, rents are probably going to come down because a lot of these folks are students, and of course, there are fewer of those, foreign students, fewer of those this year than last year. So seeing a bit of downward pressure on rents, but that's just a temporary thing.
Okay. Myles, I just wanted to go back to, you mentioned gold and almost kind of laughed about it.
Well, it's a huge weight in the TSX.
Yeah, exactly. And also just where the price is at and so on. How do you explain that? Where do you see it going? What's the significance of it?
Gold has been puzzling, I think, to every gold analyst on the planet, including us, really. You'd say that gold's going to rise if, usually it's an inverse relationship with the US dollar. Dollar weakens, gold up. Inverse relationship with interest rates. Interest rate down, gold up. But you've had US dollar up, gold up, US dollar down, gold up, interest rates up, gold up, interest rates down, gold up. So the typical drivers of gold have it's something else, right? It's something else. And maybe it's this narrative that's starting given, these deficits in most of the developed world, particularly the US, these debts are getting huge. And they're talking about the BRICS and different collections of countries are trying to move away from the US dollar to diversify their FX reserves. And this is kind of the story that's starting to get a life now. That's why I love gold, because no one really knows why it works, but you can just pitch a narrative around it. So that's the current narrative, right? The current narrative is the debasement of the US dollar, and most of the fast-growing economies are moving away, diversifying their reserves, and that's a bid for gold. But abstracting from that, when we think about gold in a portfolio, we think of it as almost like an alternative asset. It has a very reliably low correlation to bonds, has a reliably low correlation to a 60-40, has reliably low correlation to equities over periods of time. So if you include gold in a portfolio, it's a beneficial diversifier. So that's how I view it. I'm a strategy guy, but I'll let everyone else talk about why it goes up or down. But I think it is this narrative, that's my gut feel, about everyone's moving away from the US dollar, which is kind of true, kind of not. The US dollar by far is still the dominant currency for just about any global transaction, by far the dominant currency. So anyway, but it's a good story.
And from one shiny object to another, you did talk about technology. You've mentioned AI a couple of times. Where is that going? Are those 7 going to continue to drive the market? Is it a bubble?
Yeah, so AI has obviously become a really, really big deal for the markets, particularly NVIDIA because of its capabilities in that space. NVIDIA is now, the market cap NVIDIA, I think, is greater than the entire stock market of Germany and Italy combined. So it's a big stock. And look, you go through the earnings reports, these big companies are telling you collectively now, when you aggregate up their stories, they're telling you they're going to be spending $500 billion to $1 trillion a year in the next year on investments in AI and R&D related to that. These are big numbers. And these are like the top kind of 10 stocks that are doing mostly the 7, but these are massive capital infusions into this sort of sector. And you're seeing the result. Now, I think one of the interesting things is that, again, these stocks are, I already kind of mentioned it, they're in that basket of the big 10 and they're expensive. But to say they're a bubble, I'm sure a lot of people in the room, we did live the NASDAQ bubble. I'd say this is an sort of overvalued space. But a bubble is there's no way in the world you could justify the valuations. And that happened in 1999. Most of those companies didn't even make money, right? These companies do make money. They're real companies. But like I say, you think about usually buying the largest 10 companies today, which many are AI-levered companies. Again, historically, from that point forward, those biggest 10 usually underperform the market. Doesn't mean you lose money. You can, if, in the case of Nortel, if anyone remembers. But, it's not necessarily that they lose money, but as a group, they tend to start underperforming the market. So it's maybe not where the best risk-adjusted opportunity is over the next decade. It was over the last decade, because that's why they're so massive. Right? But going forward, no. But I'm not convinced it's a bubble. It's just an overvalued kind of, everyone's excited about it.
And Jeff, I don't know if your team has done any work on that, but any thoughts about from a macroeconomic perspective, what the impact of this technology might?
We can't tell, right? Like even the folks in the AI space don't don't know where this is going to go, right? It's obviously like a productivity shock, these are always good for the economy. And they cause disruptions and they displace the workers and stuff, but they're fundamentally good for the economy. It's just a matter of how good they're going to be, how quickly this stuff gets rolled out. But like the major advances of the last 20 years, 30 years, like 5 years from now, we're going to realize how is it the world operated without this stuff going forward. Like this is maybe the best example of the thing we can be the most hopeful of in terms of changing the way we do things.
Right. Okay, just have a couple of minutes left. I'll give you a couple of minutes each. Myles, what do you see as the big risks and or opportunities investment-wise over the next year, and how can people mitigate those risks?
Yeah, so, the laundry list of risks, you can just line them up. I think about them all the time. I mean, you have geopolitics, whether it's Ukraine, Russia, Middle East, you can just go on and on about that and what it may mean, disrupting supply chains and that kind of thing, ongoing or expanding, bringing in, other people into these wars, which is hopefully not going to happen. I do think that given that, we could have more aggressive federal spending over the next couple of years, I do worry that has the risk to bring back a little bit of inflation. That is a concern for me, and we know that the last time you got spooked about inflation was 2022, and bonds didn't do well, stocks didn't do well, because most financial assets don't like inflation, right? I could keep going, but those are the types of things. But what I want to sort of get back to, and what was a big part of this report, is that diversification is basically the antidote for future uncertainty. The world is a dynamic place. Financial markets are a dynamic place. There's a lot of uncertainty around both economies and financial markets. And I think the antidote to that uncertainty is to ensure you're diversified not only within asset classes, I mentioned, make sure you have a couple small caps in there, and more importantly, across asset classes. So think about stocks, bonds, don't stop there. Think also about alternatives. And this is a way I think we build a much more robust portfolio framework.
Same question to you, JF. Risks, opportunities for the Canadian or the broader economy over the coming year?
I mean, the risk, I agree with Myles. I think the risk is, set aside electoral stuff and geopolitical things, I think there might be a sense out there that we're overconfident that we've killed inflation. And, when we look at wage growth, we're still worried about that in Canada. Even in the US, to some extent, US inflation is starting to pick back up a little bit. Hopefully it's temporary, but maybe not. In Canada, productivity growth, which is, productivity declines with reasonably strong wage gains are still a recipe for upward pressure on inflation. We've got an election coming along in Canada. We've had some provincial ones, some elections, federal, that is likely to see some kind of cranked up spending. So we're not out of the inflation woods yet, I don't think. So that would be, I think, the number one kind of non-political stuff. I would also just kind of come back to something that Myles said a little bit earlier on, which is, comparing Canada to the US. The reality is that in Canada, the other thing that we worry is a strong word, that we're conscious of is there is a chance for the economy to rebound much more strongly than we think, right? When you look at excess savings, when you look at savings rates in Canada, when you look at pent-up demand, when you look at the housing market where there's still pretty tense, or we think there's potential for tenseness there, we wouldn't be surprised as we go into the spring, go into the new year, where we're cranking up Canadian forecasts up relative to where they are now. We're already like the highest of the Canadian banks on Canada, so we got to be careful there, but we're just seeing the potential for a little bit more momentum there that might make Canadian markets a reasonably attractive place relative to the American markets, where the American consumer actually has been spending a fair amount over the last year and ours haven't.
Thank you, Jean-François Perrault, Chief Economist, Myles Zyblock, Chief Investment Strategist for Scotiabank. Thank you very much. Perspectives podcast is made by me, Stephen Maurice, as well as Armina Lagaya and our producer, Andrew Norton. For a transcript of this episode, as well as other stories, insights, analysis, and thought leadership, visit our website, scotiabank.com/perspectives. We'll see you next time. This podcast has been prepared by the Bank of Nova Scotia and is provided for information purposes only. Commissions, trailing commissions, management fees, and expenses all may be associated with mutual fund investments, including ETFs. Please read the prospectus before investing. The indicated rates of return are the historical annual compound total returns, including changes in unit values, and reinvestment of all distribution does not take into account sales, redemption, or option charges or income taxes payable by any security holder that would have reduced returns. Mutual funds and ETFs are not guaranteed. Their values change frequently, and past performance may not be repeated. Views expressed regarding a particular investment, economy, industry, or market sector should not be considered an indication of trading intent of any of the mutual funds managed by 1832 Asset Management LP. These views are not to be relied upon as investment advice, nor should they be considered a recommendation to buy or sell. These views are subject to change at any time based upon markets and other conditions, and we disclaim any responsibility to update such views. To the extent this audio contains information or data obtained from third-party sources, it is believed to be accurate and reliable as of the date of publication, but the Bank of Nova Scotia does not guarantee its accuracy or reliability. Nothing in this podcast is or should be relied upon as a promise or representation as to the future. The information provided is not intended to be investment advice. Investors should consult their own professional advisor for specific investment and/or tax advice tailored to their needs when planning to implement an investment strategy to ensure that individual circumstances are considered properly and action is taken based on the latest available information. Scotiabank includes the Bank of Nova Scotia and its subsidiaries and affiliates, including 1832 Asset Management LP and Scotia Securities Inc. Scotia Global Asset Management is a business name used by 1832 Asset Management LP, a limited partnership, the general partner of which is wholly owned by Scotiabank. Registered trademarks of the Bank of Nova Scotia used under license. Copyright 2024, the Bank of Nova Scotia, all rights reserved.